high interest rates have actually pushed a lot of would-be buyers out of the market. And this is actually good news because lower buyer demand means that you have more opportunity to negotiate with sellers. But how do you get around that hurdle of high interest rates? In this video, I'm going to go over 3 hacks that you could potentially use to buy at a lower interest rate so you can take advantage of the opportunity that exists in today's market. Make sure that you stick around till the end because the last one I talk about is the one that almost anybody can use. The first hack is assumable loans. Now, these are only available on certain types of loans, and only certain types of people and certain types of property can qualify for a lot of these. Some examples of this are FHA loans, VA loans, which you have to be a veteran, and USDA loans, which are a rural loan. So it has to be a property that's within the area that is designated for a USDA loan. But if you are capable or the property is capable of qualifying for one of these, it is worth asking the list agent if the seller has an assumable loan, because then you can assume their interest rate. If they bought 2 years ago and have a beautiful 2.8 interest rate, you can assume that, and then you've completely gotten around the issue of the high interest rates. And you may be one of the few buyers who's able to do that, which may also up your ability to negotiate with that seller. Hack number 2 is seller financing. Now, there are multiple types of seller financing, and I could do a whole separate video on options in seller financing. The most basic and the one that we are most likely for you to be able to get is if the seller has paid off their home in full, they can choose to basically act as the bank for you, and then you can negotiate terms with them. And the reason that this is probably a good option for secondary homes is that we see a lot of homes that were purchased in cash or have been owned for a long time and are paid off in full, and those sellers don't need their cash out in full right away. Versus on a primary home, sellers usually need that cash to roll into their next home, so they're not going to want to do seller financing where you're paying them a certain amount per month versus in one lump sum. The other types of seller financing do make it so that you can basically assume their loan, and those would be subject to or wraparound, but again, those are worth their whole own video because they can get kind of complicated. Up here in the mountains, and the easiest one to explain to a seller if they've never been approached about seller financing is the basic seller financing where they've paid it off in full, they act as a bank. You get a note that says how much you owe them and how you're going to pay them back. And then there's a deed of trust that is registered with the county so that if you don't pay, they can foreclose on you. So a little bit more complicated, but an option to set yourself up with a better interest rate. Now, before I tell you this last option that's, I think, the easiest and the one that is available to everybody, regardless of type of property or if the seller is amenable to it, I want you to go watch this video that's on how you shouldn't time your entry to the market based on interest rates or if you think the price is going to fall. Entry to the market should be based on your needs. And that's why I think these 3 hacks are so great, is because if you can find a way to get around interest rates, you can buy property when the time is right for you. So number 3, the third hack, and this is the one that again, almost anybody can use and is the simplest, is a temporary buy down. And most lenders are offering these right now. If you need a recommendation for a lender who is offering one, I have a couple of options up here in the mountains. And the way a temporary buy down is that you buy down your rate, exactly like it sounds, temporarily. And that credit to buy down the rate can come from you or even better, from the seller. So when we're negotiating with the seller, either part of the price reduction or all of the price reduction, we might choose to take as a credit to use for this buy down. That money then goes into an escrow account and the lender pulls against that escrow account to make up for the difference between what you would be paying if you were paying the full interest rate and what you're paying based on the buy down. And how much you buy down the rate depends on how large that credit is. You can buy it down just 1% for 1 year, or you can do a 2-1 buy down, which is what you're most likely to have heard of. And in a 2-1 buy down, it's 2% for the first year and 1% for the second year. And then it goes on year 3, it goes to the full interest rate. Or there are even 3-2-1 buy downs. And with interest rates right now over 8%, a 3-2-1 buy down might be the way to go, because then you can take an 8% interest rate and drop it all the way down to a 5% interest rate for your first full year. And the idea of these temporary buy downs is that you are able to not pay so much monthly and wait for the interest rate to come back down. And then when the interest rate comes back down, you can refinance. And here's the other beauty of it. That credit that's sitting in that escrow account, if let's say you refinance 18 months in because you were at 8%, you get a 3-1 buy down, you got it down to 5, 18 months in, because it automatically switches at the year mark, you're now at a 6% interest rate, but interest rates have fallen to say 5.25. If you choose to refinance at that point, you can take the money that's left in that escrow account and apply it towards the principal of your loan. So you don't lose it, it doesn't disappear. Unlike in traditional settings, when you buy down a point, it's for the life of the loan and that money kind of just disappears. It doesn't matter if you refinance, you don't get that money back. On these temporaries, if you refinance before the end of the term of the buy down period, you get to move that money into your principal payment. And here's an example of why this is so great. On a $500,000 loan, if you buy it down 2 points, you reduce your payment by about $500 a month, which makes it a whole lot easier to carry and wait for those interest rates to come down. So hopefully I've convinced you that one of these hacks is worth trying and that you actually take this opportunity to get into the market before interest rates come back down. Because when interest rates come back down, more buyers will re-enter the market and we won't be able to get as good of a deal on purchase price as we are right now.